Welcome! Let's jump right into this explainer. Today, we're unpacking the hidden mechanics of how consumer finance companies are actually evaluated. We're looking way past those glossy credit card commercials or the promises of quick cash. Instead, we're popping the hood to look at the engine room of the industry. We want to understand what truly drives performance, risk, and long-term sustainability. If you've ever wondered what literally makes or breaks a consumer lending institution, well, you're exactly in the right place. So, here is our roadmap for today. 1. Drivers of consumer finance. 2. The customer privacy challenge. 3. Securing sensitive consumer data. 4. Fair and transparent selling. And 5. Protecting long-term value. We'll start with the big macroeconomic drivers, define our boundaries, and then dive deep into those critical internal risks that can totally sink the ship, even when the economic weather is perfect. All right, Section 1. Drivers of consumer finance, the macroeconomic weather. Let's start wide to establish the foundational forces that act as the baseline weather, dictating market success across the board. Okay, this is crucial. A consumer finance company's baseline performance is heavily dictated by 5 distinct macroeconomic realities: consumer spending, rates of unemployment, per capita GDP, income, and population growth. Think of these like the tide that lifts or lowers all boats. High consumer spending naturally drives up credit card use and loan demand, right? But you gotta balance that against unemployment rates, because if unemployment spikes, people lose jobs and suddenly they're defaulting on those loans. Meanwhile, per capita GDP and rising income levels are absolutely vital. They define a consumer's borrowing capacity and their actual strength to repay debts. And finally, population growth. This represents the physical expansion of the market itself. More people literally means more potential accounts. Without a favorable breeze from these 5 macroeconomic factors, honestly, even the best-run consumer finance company is going to struggle to grow. Before we go any further, though, we need to draw a really pristine boundary around what we are analyzing today. This industry classification includes things like revolving credit cards, which is the absolute whale in the room, along with auto loans, student loans, microlending, and prepaid debit cards. But notice what is explicitly excluded here: mortgage finance. Mortgages operate under a completely different set of rules, collateral structures, and regulatory scrutiny. Because of that, mortgage finance is covered by an entirely separate reporting standard. For this explainer, we are strictly focusing on everyday consumer borrowing. Now, while those macro factors we just talked about are vital, investors really need the whole picture. That's where the SASB standards come in, which, as you can see, are now managed by the International Sustainability Standards Board. This framework acts as our definitive guide. It tracks the internal, operational vulnerabilities that matter just as much to a company's survival as the broader economy. Moving on to Section 2, the Customer Privacy Challenge, managing secondary data use. Let's look at how mishandling demographic, behavioral, and location data exposes these companies to massive risks. What's fascinating here is how a complex accounting standard actually translates into our everyday reality. Consumer finance companies collect an absolute mountain of data just to issue a credit card. But the big question is, what happens to that data next? The standard focuses on secondary purposes. This essentially means intentionally using data for something completely outside the primary purpose it was collected for, like managing your loan. We are talking about selling behavioral and demographic data to third parties or using it to blast people with targeted ads. Because that data is incredibly valuable, the temptation to monetize it is, well, it's huge. But doing that in the shadows, that destroys trust. To maintain consumer confidence and dodge public backlash, investors demand to know if companies have an explicit affirmative consent policy. This means they want to see a clear, unambiguous opt-in mechanism for using customer content for those secondary purposes. They don't want it hidden deep inside some 40-page terms of service agreement. And here is the so what of why investors care so deeply about those privacy policies. If a company fails at protecting customer data or deceives people about how it's used, this is the ultimate consequence they have to report: the total amount of monetary losses as a result of legal proceedings. We're not talking about a slap on the wrist. We're talking hard financial hits from civil judgments, massive regulatory penalties, and even criminal actions. Bad privacy practices literally eat into profit. Next up, Section 3. Securing sensitive consumer data, defending the ship from external threats. We're shifting from internal data policies to the relentless, ever-evolving cybersecurity attacks targeting financial services from the outside. Look, when breaches happen, fraud inevitably follows. But not all fraud is created equal. Investors specifically require companies to break down their fraud losses into two very distinct categories. First, card-present fraud. This is the old-school unauthorized physical use of a card face-to-face with a merchant. But then you have card-not-present, or CNP fraud. That's unauthorized use online or over the phone. Splitting these metrics is a game changer because it helps analysts see exactly where a company's vulnerabilities are. Are they losing the battle to physical theft, or are their online gateways fundamentally compromised? And to truly grasp the sheer scale of this data security threat, companies report these specific activity metrics: the number of unique consumers with active accounts, and the total number of credit and prepaid accounts. By disclosing these exact numbers, we see the true size of the target painted on the company's back. I mean, think about it. A data breach affecting 1 million unique consumers requires a totally different crisis response than one affecting 10,000. All right, Section 4, Fair and Transparent Selling, the Internal Compass. Here, we examine company culture and how employee compensation might actually, and sometimes unintentionally, encourage selling products that are definitely not in the client's best interest. Let's walk through how this builds into a perfect storm. This sequence perfectly maps out the chain reaction of selling risks. It's really a follow-the-money flow. Step 1. Variable remuneration is linked to sales targets. You incentivize staff heavily based on volume. Step 2. To hit targets, staff push through high approval rates for credit and prepaid products for practically anyone. Step 3. To maximize commission, they stack on excessive add-on fees alongside high average APRs. And Step 4. This concentrated risk blows up. It leads to a flood of customer complaints that ultimately force the company into paying out monetary relief. The root of that whole chain reaction usually stems from variable remuneration. What is that? It's basically any pay that isn't a fixed salary, compensation that varies wildly based on performance, risk assumption, or the sheer amount of products and services sold. Investors demand to know the exact percentage of pay tied to these variable incentives, especially for sales managers. If a massive chunk of a manager's paycheck depends on pushing credit cards, that is a glaring leading indicator of potential aggressive or deceptive practices on the horizon. And much like with our privacy metrics earlier, failing to be transparent about those primary and add-on products ultimately hits the bottom line. The metric here is the total monetary losses from legal proceedings associated with selling and servicing. Deceptive selling exposes a company to incredibly costly and lengthy litigation from regulators and ombudsmen. Those short-term commission gains, they get instantly wiped out by long-term legal judgments. Finally, we've arrived at Section 5, Protecting Long-Term Value, Aligning Interests. As we wrap up this explainer, we really need to look at how protecting the consumer is intrinsically tied to protecting the investor. Trends towards consumer protection and transparency have aligned and will continue to align the interests of society with those of long-term investors. This is a powerful statement pulled directly from the standard, and it highlights the core philosophy of modern financial analysis. Sustainable, long-term revenue growth doesn't come from tricking customers with hidden fees or secretly selling their data. It comes from building a bedrock of trust. Prioritizing products that actually serve the customer's best interests is what expands market share safely and reliably over time. So, I'll leave you with this. We've seen that the macroeconomic weather, factors like GDP, consumer spending, and employment, sets the absolute ceiling for a company's baseline performance. But it's those internal guardrails, privacy, data security, and fair sales ethics that dictate survival. They prevent the floor from falling out. So which one truly defines long-term market success? Next time you evaluate a consumer finance company, I encourage you to look way beyond their basic profit margins. Ask yourself, are they just riding a lucky economic wave? Or have they built an ethical, secure ship that can actually survive the storm? Thanks for joining me for this explainer.